Hi guys, I'm gonna send the link to you all now on the WhatsApp chat. All right, good. All right, so there you go. Let's get cracking. Oh, I've only seen 3 persons coming in, so I'll wait. I'll wait a few minutes to get for the other students to join in. All right. How many are we at? We're at 5. All right, so let's go. So we're doing. This is lecture number 4, inventory management. Inventory management. So let's go. So we know that we said last week, and we've been saying last week, that your human resource is a very important component of your company. But also absolutely important is your inventories, especially if you're in a retail environment or even a wholesale environment. Your inventory is what you're going to sell in order to get revenue, in order to hopefully declare a profit. So managing your inventory is very important, and managing it well is very important. So hopefully some of you would have a background in accounts or have some little idea of this, so it can be easy to understand and you can assist with your classmates as well. So the first thing we're going to talk about is the purchase order, and these are some definitions that you're going to see. The purchase order is an authorized a piece of document authorizes an approved purchase from an approved vendor. And in companies and large companies, especially, you would have approved vendors. And some purchasing can't be done by phone or by a simple email. It must be using the document of a purchase order, especially when it comes to auditing financials and financial accounts, audited accounts. The purchase orders are uh, important in the reconciliation of documents. Receiving report, the when you receive your inventory, we also call it the invoice or the delivery note in some cases. On those things, you have the price, quantity, description of the item on purchase, and compared to the vendor's invoice before the inventory is recorded. All right, so the last point, controls for safeguarding an inventory should include security measures to prevent damage and customer or employee theft. Now, can you all think of something that you may have experienced with a product in a store that is done to prevent it from being stolen? Give an example of something that you noticed, or whilst cashing, you noticed that the cashiers have to do something with your product to ensure that record keeping for the product. Tracy? Oh, you mean, okay, so you mean as the product is sold, you write down that the product was sold, is that it? In Payless, have the tag very, that's right, good. Firaz, Kai, and Kai, yes. Tracy, like medicines. You mean like like in a regular community pharmacy. This is for Tracy. That if an item is, you take the last item to be sold, you sell it, you write it down in the book to reorder. Is that it? What you're looking at, Tracy? And yes, Firaz, Kai, and Marie. Yes, the plastic barcode thing, security tags and clothes. Perfect, right? So and also, okay, Tracy. Yes. And also in the alcohol section of the groceries, you would see they put this big plastic tag on the alcohol bottle that has to get removed. So all of those things are meant to reduce theft by both employee and customers, because an employee can, if they put it through the bag and then they walk through the detector at the door, is going to beep off. All right. So safeguarding the inventory is very important, and I want you all to start thinking along those lines. When you get into your management position, when you get into your junior positions, about safeguarding inventory. Look at how easy inventory can disappear. And in the business world, we talk about a term called shrinkage. And shrinkage simply means your inventory is not where it's supposed to be. It may be in another location, an unauthorized location, or it might be stolen. But it all comes under the full umbrella of shrinkage. And you need to start putting things in place to prevent that from happening. Your physical inventory account should be taken every year, and to ensure that the correct inventory figure is reported in the financial statements. And when we go to financial statements later on, you're going to see how important getting your inventory count to be accurate and to be on point. So inventory cost flow assumptions, and we look at we're going to look at the first in, first out, last in, first out. And the specific identification cost flow method talks about the unit that is sold is associated with a specific purchase. With first in, first out cost flow method, the first units purchased are assumed to be sold, and the ending inventory is made up of the most recent purchases. And you're going to be later on in the lecture, and in next week lecture as well, you're going to see how these things affect the costs. The other one is last in, first out, where the last amount of goods received are assumed to be sold, and the ending inventory is made up of the first purchases. Now, these are things that you can use that can be used to alter and adjust your financial reporting. And under the weighted inventory cost flow method, the cost of the units sold in total is a weighted average of all the purchases. So they look at your total purchases, and they make an average of it. So the first in, first out method is, you would think, and I would hope that it's a practice as well. New items come in, go to the back, and the older items come forward, unless the new items have shorter expiry dates, unless you want to use your new items coming in with a lower price for a promotion, But generally, your old products come to the front, your new products go to the back. Um, as I said, and this is hammered home in the second point, where it's the same as the physical flow of the merchandise. So this inventory costing method, or first in, first out, is in line with your physical merchandising of the shelf, right? The third point talks about expiration dates, etc. The last in, first out method, where the cost of the unit sold is the most recent purchases. So when you're looking at the COGS, which is the cost of goods sold, you compare that to the most recent purchases, and that's what last LIFO is about, right? And just look at the second point. on slide number 6. For tax purposes, it's now widely used even when it does not represent physical flow of units. So using the last in first out method is something that accountants use to help to alter and adjust your tax sheets and your tax reporting. And we're going to see later on the different types of reporting that you would use for your financial institutions versus your regulatory institutions. The weighted average cost, you take an average of all the purchases made, and it's also called a moving average. Remember that? I'm going to put this in your notes. Weighted average. All right. Take note of that, please. So under the periodic inventory system, only revenue that is recorded each time a sale is made. No entry is made at the time of the sale to record the cost of the merchandise sold. So it's the cost flow assumption is made when identical units are acquired at different unit cost during the period. Right. So if you look at your diagram on slide 9, you look at all your purchases and the same item that may be purchased at different prices. And this is to give an example of how your last in first out and your first in first out operates. And see how it can affect on your right hand side the cost of the merchandise sold. So that's first in first out, last in first out. So you get an appreciation of the difference in values that you see in there in slide number 9 versus slide number 10. Look at the cost of merchandise sold, the figure. In the first slide, first in, first out, you see by using the first amount of goods that you purchase at the earlier dates, that feeding into the cost of merchandise sold to be 26,000, and on the other one, the last in first out, the cost of merchandise sold to be 29,000. So all of those things, when it's being reported in your financial statements, is going to affect your balance sheet, as you'll see later on. So there's a formula here on slide number 11 for the weighted average unit cost total. So it's the total cost of units available for sale over the units available for sale. So cost versus physical quantity. Right, so cost of goods merchandise sold is also called cost of goods sold, and I'm going to introduce this COGS. And COGS is not for come on you Gunners for Arsenal fans. It's cost of goods sold. Right, we have any Arsenal fans in the class? I know they got some licks yesterday. Just side note. Right. So the cost of merchandise sold is something that's going to be reflected on in your balance sheet and in your financial reporting, and it's going to alter and affect how much taxes you pay or how strong your balance sheet is going to look when it comes to financing. So the beginning of the inventory, we are looking at slide number 12. Beginning inventory is 20,000. During that period, during the period that you're reporting on, your purchases was 11,002 plus 13,998, carrying you up to 25,000. The cost of merchandise available in January is 45. And the end of January, you end up with an inventory of 17. That means the amount of merchandise that you sold is 45 minus 17, which is 27. So that's how your cost of merchandise is calculated. So the three different methods yield different amounts for the cost of merchandise sold, gross profit, net income, and ending merchandise inventory. Now these things here, these four things, as I keep mentioning, will affect on your balance sheet. See, no Arsenal fans on this in class. Okay, so these accounting inventory methods affect the balance sheet. Amongst other financial reports. All right, so that's why we're doing this, because these things will affect your financial reporting. And remember, your financial reporting is important for purpose of tax paying as well as getting financing from the bank. And so if the costs remain the same, all three methods would yield the same results. However, costs and prices normally change. Now, if during the period, let's just say you are comparing, you're doing your 1 year financial reports, and from January of 2020 all the way to December of 2020, there was absolutely no change in your inventory cost. So let's just look at one product, Augmentin 625. The cost of Augmentin 625 in January was the exact same cost of Augmentin 625 in December 2020. Then you're going to get the same results, no matter if you use first in, first out or last in, first out. But last in, first out, as I said, is used because there's the assumption that prices change, prices increase, and you use it to adjust and to adjust your financial reporting to suit your needs. So the FIFO, the first in, first out, reports higher gross profit and net income, and the last in, first out does than the last in, first out. So if you use first in, first out, you're going to see higher gross profit, higher income. And what is that going to be good for? Using first in, first out to give you higher gross profit and higher income would be good for the banks, because the banks are going to see that your company is profitable, you're doing well with revenue streams. Whereas the last in, first out would do the opposite. And what would that be good for? That would be good for your calculation of taxes. And both of them are absolutely within the law. Doing whichever inventory costing method you use, they're all within the law. Um, just a point to note, in cases where the larger first in, first out gross profit and the net income are sometimes called inventory profits or illusory profits. Comparing the cost methods again, we're on slide number 15. So last in, first out offers an income tax savings during periods of increasing costs. So understand, as a business, you want to always reduce your overheads and reduce expenses that the business would have to incur. And believe it or not, tax is definitely one of those expenses. And uh, you are doing you're paying your taxes within the law, but nobody wants to overpay taxes. And using the last in, first out method helps you to produce a lower gross profit and therefore a lower taxable net income, right? So the weighted average is a compromise between last in, first out. As mentioned earlier, it gives an average of the amount of money that was paid. So you paid $50 today, and next month we pay $56, and the third month we pay $53. They all added, and they produce. You get an average weighted cost of that particular item. The cost of the cost trends is average and determine cost of merchandise sold and the ending inventory. Valuation at lower cost or market. So if the market is lower than the purchase cost, the lower cost of market method is used. So if the price that you're going to have, if it is you bought something that you paid much higher than what the average market is, you're going to have to use lower cost of market method to value the inventory. And we have a formula there for net realizable value, which is the estimated selling price minus the direct cost of disposal of the item. The lower cost or market method. Lower of cost or market method can be applied in three ways: the market price, and any declines that could be determined for the following. Right, so merchandise inventory is usually presented in the current assets section of the balance sheet. And we're going to go to financial statements later on. So you're going to have a better appreciation of where these figures are going to be plugged in to get your financial reporting. So any errors in merchandise inventory will affect the balance sheet and the income statement. So that's why you need to be on point. You can't start off your year with your beginning inventory balance to be $500,000, and then at the end of the year it's a figure that's really strange and erratic. It should be pretty consistent so that you won't raise any red flags in your financial reporting as well. So that's why a good inventory count needs to be done just before you do your financial statements. All right, so some reasons that inventory errors can occur: physical inventory was miscounted, costs were incorrectly assigned to inventory. Inventory in transit, meaning that you didn't receive the physical inventory as yet. Consigned inventory that was consignment is when items are given to you without you actually paying for them as yet. And at year end, items that are supposed to be incoming can also cause errors in your inventory reporting. And the term title to merchandise. So the shipping terms determine the title to merchandise. I don't know if you all could remember, but there was some controversy some months ago about some fuel that left Trinidad and ended up reaching Venezuela, where it was initially destined for Aruba. So the Minister of Energy used the term title to the merchandise. So as the seller, you maintain title or ownership of the merchandise until the merchandise is fully paid for and received. So understand that I might be physically selling something to you. You might pay me for it, but it's still in my possession. I still have title to it. Only when it is fully paid for and you take possession of it, then I no longer have title to the merchandise or ownership to the merchandise. All right? I don't know if you all can remember. I don't if you all look at the news and saw that statement being made, but that's what title to merchandise means. Right? So again, just continuing on explaining why some inventory errors occur. Talking about consignment. Any unsold merchandise at the end of the year is part of the manufacturer's inventory. This is where consignment. We're talking about consignment. So on slide number 21, you can see how the inventory errors can affect those three parameters on your income statement, where an understated inventory can lead to understated cost of merchandise sold, and an overstated gross profit, and an overstated net income, and uh, uh, increased overstated in beginning inventory. So you just take a look at this diagram, and you can have you can have an appreciation of how this can affect your income statement. And remember, we're talking about how inventory can affect your financial reporting, and how it can increase or decrease your abilities to get financing, or how it can increase or decrease the amount of tax that you pay. So that's the real reason behind your inventory management. Right, so this looks at beginning inventory error in the beginning and ending, and we have some formula that we're going to look at here. Inventory turnover is the cost of merchandise sold over the average inventory, and inventory turnover measures the relationship between the cost of the merchandise and the amount of inventories that is carried during the period. The number of days is the second item on slide number 23. The number of days sales in inventory, average inventory over the average daily cost of merchandise sold. And it tells you the length of time it takes to acquire, sell, and replace the inventory. So that's number of days sales in inventory. Inventory retail method is estimating the cost that is required, and the retail prices to be determined for the merchandise for sale. And finally, your gross profit method for inventory costing is where it utilizes the gross profit for the estimated period and to estimate the inventory at the end of the period. So the gross profit is estimated from the preceding year, adjusted for any current changes and changes in the cost and sale prices. So that's it for inventory reporting. I think this lecture is a little different to the one we did last year. Let me just confirm. All right, so that's it for inventory management. I know it may be new to some of you because the accounts and those things, I know some of you wouldn't have touched on these terms until now. So just go through the PowerPoint presentation, and if you have any questions for me, as we're going to take the break and we're going to come back at 11 to do the final lecture for the day. Final lecture for the day would be, we're going to start on financial statements, because we did in conflict, and we're going to start on financial statements. Right? So any questions before we go for the break? I know this lecture was a little tough one, but in your free time, just go through the PowerPoint, look over the lecture, and if there's any questions, we could discuss it next week. Any questions before we go for break? No questions, anyone? Okay, so taking a break. We start at 11 a.m. All right, good. So see you at 11 a.m. and I'll do the same. I'll set up the live and I will send the link on the group. Thank you.